Warren Buffett, one of the most renowned investors of our time, is often quoted as saying, "Be fearful when others are greedy, and greedy when others are fearful." On the surface, this advice seems straightforward: act contrary to the crowd and seize opportunities when others hesitate. Many interpret it as a simple call to buy low and sell high, capitalizing on market sentiment. However, the true significance of Buffett's words runs much deeper than this basic interpretation. To fully appreciate the wisdom behind the quote, it's important to explore the context in which it was given and the principles that guide Buffett's investment philosophy. This sets the stage for a more nuanced understanding of what it really means to follow his advice. A frequently cited piece of investment wisdom cautions against the temptation to chase hot stocks. This advice stems from the observation that stocks, which have recently performed well, may not continue their upward trajectory. Relying solely on past performance can lead investors to make decisions based on trends that are unlikely to persist. Instead, experts recommend taking a more measured approach, focusing on fundamentals rather than short-term gains. By avoiding the allure of recent winners, investors can reduce the risk of buying at inflated prices and experiencing subsequent losses. This guidance encourages a disciplined strategy, emphasizing long-term planning over impulsive reactions to market hype. Consider this: what if the way most people understand this famous quote is not only incomplete, but could actually lead us astray? We often accept popular interpretations without questioning their accuracy or depth. But what happens when the accepted meaning oversimplifies the original intent, or worse, distorts it altogether? Could relying on a misleading version of the quote influence our decisions or beliefs in unintended ways? This central question invites us to look beyond surface-level understanding and explore the true significance behind the words. The phrase "modern-day trap" refers to subtle challenges that individuals face in contemporary society, often concealed within familiar ideas or statements. These traps can influence our decisions and perceptions without us even realizing it. To fully understand the impact of such a concept, it's essential to look beyond the surface and examine its origins. By exploring the historical context behind the quote, we can uncover how similar patterns have emerged over time and why they continue to persist today. This deeper investigation allows us to recognize the underlying forces at play and equips us to navigate modern life more thoughtfully. A common misinterpretation of the quote suggests that investment success hinges primarily on timing the market and being among the first to act. Many believe that getting in early guarantees outsized returns, but this perspective oversimplifies the complexities of investing. In reality, successful investing involves a combination of thorough research, patience, and discipline, rather than just speed. The notion that timing alone determines outcomes ignores factors like market cycles, company fundamentals, and long-term strategy. By focusing solely on being early, investors risk overlooking the importance of understanding what they are investing in and why. True success often comes from making informed decisions and maintaining a clear perspective, rather than chasing trends or trying to outpace others. The timing-based interpretation suggests that market movements are primarily driven by the sequence or timing of events. However, this perspective is incomplete because it overlooks underlying factors such as company fundamentals, broader economic trends, and investor sentiment. Focusing solely on timing can lead investors to ignore the deeper causes of market shifts, such as changes in business models or regulatory environments. This distraction may result in misguided investment decisions, as it encourages short-term speculation rather than thoughtful analysis. Ultimately, understanding the real drivers behind market behavior is essential for making informed choices rather than relying on timing alone. As we move forward, it's important to clarify the true essence of the quote. while it may seem to reference timing, its core message actually centers on price. The distinction lies in understanding that successful decisions are less about predicting when to act and more about recognizing the right value. By focusing on price, we shift our perspective from trying to time the market to evaluating whether an opportunity is genuinely worthwhile. This approach encourages thoughtful consideration and helps avoid the pitfalls of speculation. Ultimately, the quote reminds us that price is the key factor in making sound choices. In the late 1990s, the dot-com bubble was in full swing. Technology stocks soared to unprecedented heights, and investors were captivated by the promise of the internet revolution. Amid this frenzy, Warren Buffett stood apart from the crowd. He cautioned against investing in companies with little proven profitability, emphasizing the importance of sound business fundamentals. Buffett's reluctance to join the tech stock craze was widely criticized, with many labeling his approach as outdated. Despite the overwhelming enthusiasm for internet startups, he maintained his disciplined investment philosophy, even as others questioned his judgment. This period highlighted Buffett's commitment to long-term value over short-term speculation. Warren Buffett's remarks were not aimed at the operational quality or innovation of technology companies themselves. Instead, his concern centered on the exceptionally high prices that investors were willing to pay for shares in these firms. Buffett observed that market enthusiasm often led to valuations that far exceeded reasonable expectations based on company fundamentals. He cautioned that such inflated prices could expose investors to significant risks, regardless of the underlying strength of the businesses. This distinction is important, as Buffett has consistently acknowledged the impressive achievements of many tech firms while remaining wary of speculative investment behavior. Warren Buffett's thought experiment on the auto industry offers a powerful lesson about investing. Imagine knowing in advance that the automobile would revolutionize transportation and become a dominant industry. Despite this accurate prediction, thousands of car companies emerged, but only a handful survived over the decades. Many investors lost money, not because the industry failed to grow, but because they paid too much for their investments or chose the wrong companies. Buffett's point is clear. Even when you foresee tremendous growth, investment success depends on buying at the right price and selecting businesses with enduring advantages. This example underscores the importance of valuation and discernment, reminding us that growth alone does not guarantee profitable returns. The real insight behind this quote is that simply identifying a company with strong growth prospects is not enough to guarantee investment success. If the market already anticipates this growth, it will be reflected in the company's current share price. Investors only stand to benefit when actual results exceed those expectations, or when the market has underestimated future growth. In other words, profits are made from surprises and misjudgments, not from widely accepted forecasts. This principle underscores the importance of independent analysis and seeking opportunities where the consensus may be wrong. It reminds us that in efficient markets, knowledge that is already common rarely leads to outsized returns. Many people believe that consistent, small investments will inevitably lead to significant wealth over time. This popular lesson is often reinforced by anecdotes and simplified projections. However, the actual mathematical reality of investing returns is more complex. Evidence shows that market fluctuations, fees, and the timing of investments can dramatically affect outcomes. Compound interest does play a powerful role, but it is not a guarantee of uniform growth. Historical data reveals that returns vary widely and are subject to periods of both gains and losses. Understanding these nuances is essential for setting realistic expectations and making informed investment decisions. Even experienced investors can be drawn into the allure of chasing tomorrow's growth. In the quest to identify the next big winner, they often focus on companies with promising future prospects sometimes overlooking the risks involved. This can lead to paying excessively high prices for stocks based on optimistic forecasts rather than current fundamentals. When expectations are set too high, even minor disappointments can cause sharp declines in value. The modern market environment, fueled by rapid information flow and speculative trends, makes it easier for investors to justify these lofty valuations. Ultimately, overpaying for future potential can undermine long-term returns, reminding us that disciplined investing requires balancing hope with realism. Consider an investor who buys shares in a rapidly growing company, expecting that its impressive earnings will continue to soar. If the investor pays a high price today based on optimistic projections for future growth, much of that anticipated success is already reflected in the purchase price. For example, if a stock trades at a price-to-earnings ratio far above its historical average, even strong future performance may only justify the current valuation rather than deliver outsized gains. Should growth slow or fall short of expectations, the stock price can stagnate or even decline, resulting in disappointing returns. This mathematical trap highlights how paying too much for future potential often leaves little room for upside, as the market has already priced in best-case scenarios. Over time, investors who consistently pay premium prices for growth may find their long-term returns lag behind more disciplined approaches. In the year 2000, Microsoft was widely regarded as one of the world's most successful technology companies. However, investors who purchased Microsoft stock at its peak during the dot-com bubble quickly discovered the risks of overpaying, even for a market leader. The company's stock price remained stagnant for more than a decade, despite continued growth in revenue and innovation. This period of underperformance was not due to any fundamental weakness in Microsoft's business, but rather the inflated valuation at the time of purchase. It wasn't until the mid-2010s that the stock finally surpassed its previous highs, illustrating how paying too much for a great company can result in prolonged periods of disappointing returns. The Microsoft 2000 case serves as a cautionary tale for investors to consider valuation as carefully as company quality. The true takeaway is to prioritize the margin of safety when making investment decisions. Rather than getting caught up in the excitement of rapid growth or lofty projections, it's wiser to remain cautious and avoid overpaying for optimism. By focusing on the underlying value and ensuring a buffer against unforeseen risks, investors can protect themselves from potential losses. This approach encourages discipline and patience, steering clear of speculative trends. Ultimately, sustainable success comes from careful analysis and prudent judgment, not from chasing the latest growth story. True investment safety is achieved when you purchase assets at a sensible price. This approach ensures that your investment is protected, even if future growth does not materialize as expected. By focusing on value rather than relying solely on optimistic projections, you build a margin of safety into your decisions. Any future growth then becomes an added benefit rather than a requirement for success. This mindset helps investors avoid unnecessary risks and maintain stability in their portfolios. Investing should be a journey marked by safety, peace of mind, and ease. By following thoughtful strategies and remaining disciplined, you can navigate the financial landscape with confidence. We encourage you to approach your investments with care, always prioritizing your long-term goals and personal well-being. If you have your own investing rules or favorite quotes that guide your decisions, we invite you to share them. Your insights may inspire future discussions and help others refine their approach. Together, we can build a community focused on smart, secure investing.